Good day, everyone. Welcome to our webinar for June month. We begin as usual in America, where Wall Street has been making a series of new record highs. The great bull trend, which began in March 2009, is continuing. There is a parade now of so-called experts who pop up from time to time and predict impending doom. They say that the US economy and the stock market are about to collapse. Right now they are saying that the problems will probably begin before the end of this year, and some of them are basing their predictions on the inverted yield curve. Of course, that inverted yield curve may have more to do with the fact that China has been selling US Treasury bills. They have been rotating out of T-bills and into gold. In the year to March 2024, they sold more than $100 billion worth of T-bills, and their gold holdings rose by 27 tons in the first quarter of this year. Some of the bears say that many US states are already in recession. Others say that the S&P 500 index is only being held up by 5 high-tech shares, called the Magnificent Seven, and that they account for about 30% of the S&P's rise so far this year. Our experience of bear markets goes back to the 1969 bear market. And we have noticed in all those different bear markets over the decades that bull trends are almost always marked by bearish predictions. As the market goes up, some expert decides to call the top. Usually it is someone who already has a reputation as some sort of guru. Then after a few months, when the market is still going up, they lose credibility, and everyone who sold on their advice loses money. That guru is then discredited and joins a group of failed bear predictors. I have come to call this process the elimination of the bears, and it's a characteristic of most bull trends that I have seen. The market keeps going up, and one by one the bears get discredited. Eventually, a point is reached where no one dares to call the top. And that is the point where you should become concerned. When the bears disappear, everyone is a bull, that is the time when you should begin quietly moving back into cash. But while there are plenty of bears around, you are probably reasonably safe. And this raises the question of October month later on this year. October, of course, is always a bad month for the stock market, mainly because of the crashes in 1929 and then again in 1987, which both began in October. This reputation causes some investors to sell out as October arrives and sit in cash for the month. So it has sort of become a self-fulfilling prophecy, if you like. Anyway, take a look at the S&P 500 chart, which should be on your screen. You can see here the cycle high that it made at 5254, and that was on the 28th of March this year. And then it entered a correction, which took it down 5.5% to the cycle low here at 4967. Since then, we've had a strong upward trend which broke above that previous cycle high at 5254 and has been moving around above that level. Obviously, once you break up through a resistance level like that, the resistance becomes a support level. And you can see that last week, that support level was quite seriously stressed, quite seriously tested, but it managed to hold on just. And this week, on Friday and this week, we've had 3 hammer formations in a row. You can see them here. These are hammer formations. A hammer formation is one which has a relatively small body, and it doesn't matter whether the body is red or green, and a long downward shadow or tail. This shows that the bulls tried to push the market down, got it all the way down to this low point, and then the bulls, so the bears try to push the market down, got it all the way down to that low point. Then the bulls managed to push it all the way back up to close there. So it basically shows you that the bulls won the day. And it's called a hammer formation, and it's quite a bullish formation. All right, of course, the market is discounting quite a lot of uncertainty as the presidential elections of November the 5th come closer. Trump, of course, has been found guilty of 34 felonies to unfairly win the 2016 election. In our view, this will negatively impact on his support. It may even impact on his nomination for the Republican Party. And there may be more criminal trials before the election, for example in Georgia. Some independents have said they will definitely not vote for him if he is a felon. In the vital swing states, their votes could make the difference between winning and losing. But there are 5 long months before the election, and anything can happen. We do note, however, that Trump's speeches are becoming less coherent than they used to be. They are not focused really on what he will do for the American people. They are more about painting himself as a victim and vowing revenge. We think it's possible that he is suffering from some type of progressive dementia. His conviction was not marked by nationwide protests as he had predicted, and the latest polls are showing a definite swing towards Biden. Looking at the U.S. economy itself, it is showing signs of beginning to cool. This is fueling optimism among investors that interest rates might come down before the end of this year. The expectation, in fact, is that there will be a 25 basis point drop in interest rates in September. Non-farm payrolls came in during April month at 175,000 new jobs created. This was well below the economists' expectations of 243,000 new jobs, and it was nearly half of March's figure of 315,000 new jobs. Unemployment rose slightly to 3.9% from March's 3.8%, and of course that compares with the average over the past year of 4.1%. The Consumer Price Index fell to 3.4% from March's 3.5%. And the PCE figure, which came out late last week, was more or less in line with expectations. The Fed's objective, of course, is to get the PCE down to 2%. So there's a little way still to go there. The 7 companies, known as the Magnificent Seven, are leading Wall Street higher. They are Microsoft, Apple, Alphabet, Amazon, Meta, Tesla, and Nvidia, of course. Together they produced $108.9 billion in first quarter profits, just those 7 companies. The average gain of S&P 500 companies was just 5.5%, but Nvidia's revenue has gone up 500% over the last year, and in this quarter it made a profit of $15.4 billion. Amazing. A major factor, of course, in the improved inflation figures is the fall in the oil price. So I'd just like to quickly look at that. Okay. Let's pull in a bit more data here. Okay, here you can see the oil price. This is the North Sea Brent oil price. And here on this side is the Russian invasion of Ukraine. That's what the spike is about. Then Biden visited Saudi Arabia, and after his visit, the oil price fell all the way to the support here at $72. That support has held quite well. And then recently we had this rising trend, and we had a cycle high there at 91.60. But since then, the oil price has been falling. And yesterday and the day before, it dropped quite sharply down to the high $70 barrel area. So, of course, oil is a major factor. And this drop in the oil price may be a result of the worse than expected jobs number in America. but I don't really think so. I think the oil price is a result of many diverse factors, and it's now trading at around $79 a barrel, which is obviously very good for Biden in his efforts to get re-elected as president, and very bad for Putin because it cuts the Russian revenues coming in from oil sales. And that takes us to Ukraine. Just looking at the Ukraine situation, Ukraine is recovering rapidly from the delay in the US aid package, the $61 billion aid package that was delayed by the Republicans. Ammunition is again flowing, and Russia's Kharkiv offensive has been stopped in its tracks. Ukraine is, of course, using drones to strike deep into Russian territory, and it's targeting oil infrastructure and other key facilities. American long-range ATACMS missiles pose a significant problem for Putin. Now that the Ukrainians are permitted to use those to attack targets within Russia, it is a big problem. Another big problem, of course, is the arrival of the F-16s, these fighter airplanes with trained Ukrainian pilots. This will severely limit Russia's ability to use glide bombs on the front, and it will also enable the Ukrainians to use glide bombs to attack targets quite deep into Russia. Both of the countries, Ukraine and Russia, have conducted conscriptions to get more soldiers. They are both desperately short of men. France, being aware of this, Macron has sent the French Foreign Legion. There are reports that the French Foreign Legion has 100 or so men in Ukraine already acting at the moment as trainers. But of course, this is the beginning of a new phase, an escalation, if you like, of the war. To us, it seems inevitable that the war will escalate to include NATO troops. And those troops will have to be supplied with NATO weapons. NATO cannot simply allow Russia to win this war. Putin has been threatening nuclear attacks, but he has done that too many times now to be taken seriously. The sharp decline in Russian oil revenues is really hurting his economy, and there are signs of an internal revolt against Putin's rule. He appears to be gambling everything on a Trump win in November in America. Okay, let's turn our attention now to what's going on here in South Africa, which is quite momentous. The election, of course, is over, and the ANC, having lost its majority in Parliament, is now forced to make an alliance. The resounding message from the electorate seems to be service delivery. They're very unhappy with service delivery in this country. The big surprise in the election was the formation of MK, Mkhonto weSizwe, and they got a surprisingly high 14.6% of the vote. But they have said that if they are going to make an alliance with the ANC, Ramaphosa must go. The ANC has responded and said that that is not an option. Ramaphosa and Zuma, of course, are bitter rivals, and they will not partner easily. The EFF has too little support, really, to give ANC control, so they would have to take in a third partner. It will also be a very difficult partner to have for the ANC. So their best option seems to be the DA. The DA's policies are quite similar to those of the Ramaphosa administration, or at least that side of the ANC. An alliance would give them a solid 62% of the electorate, and Ramaphosa can rely on any deal he makes with the DA, which is not necessarily true with the other two major parties. Also, an EFF or MK alliance will be a massive negative for the economy. An alliance with the DA will probably enable Ramaphosa to get rid of some of the extreme elements within the ANC and result in a stronger rand. It is almost impossible to predict exactly what will happen, but it's going to happen in the next week or so. If we are right and the ANC makes an alliance with the DA, it will be a huge win for the economy. An MK or EFF alliance will immediately cause the rand to fall. An alliance with the DA will bring rand strength. Negotiations with the DA will have to resolve various areas of disagreement, like the NHI, the National Health Insurance issue, land redistribution, the affirmative action policy which the ANC has, the ANC's policy of cadre deployment, and also the leadership of various key ministries like the Ministry of Minerals and Energy. But we see these issues as being relatively easy to negotiate and settle. Let's look at the South African economy now. South African businesses have moved quickly to adopt renewables. This is the main news here. Renewables are both cheaper and obviously more reliable than Eskom. The government says that about 22 gigabytes of renewable energy will be installed and operational within the next 3 years. All of this new power is being built by the private sector, and it is a result of Ramaphosa changing the rules to allow for private companies to build large installations of renewables. Once the economy is switched over to renewables, it will have a major impact on growth and productivity. Now, because there is less demand for Eskom's electricity, its energy availability factor, or EAF, is now around 70%, with something of a record. But renewables cost less than Eskom's electricity, and are more reliable, and that results in better profits. Over time, that will have a massive impact on the economy. The Monetary Policy Committee at their meeting decided on Wednesday last week to keep rates unchanged, interest rates in this country, partly because of the uncertainty resulting from the election. The MPC is expecting inflation to fall to 4.5% this year, to average about 4.5%, and it will fall there to that level in about the second quarter and average 4.5% also in 2025. Gross domestic product is expected to grow by 1.2% in 2024, although if there's no further load shedding, that could be as high as 1.7%. South Africa's inflation rate is undoubtedly the ANC's best achievement over the past 30 years. But they never even mentioned it in their efforts to win the election. Growth this year will of course be impeded by high interest rates. Rates are now expected to stay high for longer, in line with America. The leading indicator came in down 1.9% in March after rising 1.3% in February. Standard Bank says that nearly 100 billion rands worth of bond debt is now at risk. In other words, people are battling with the high interest rates to keep meeting their obligations to pay their bond. Rates are up 4.75% since November 2021. Most homeowners are paying as much as 40% more on their bonds than they used to. Middle income earners with a salary around $35,000 a month have been the hardest hit. Many of them have decided to go into debt review as a result, which gives them a relief from their creditors, but obviously damages their credit rating. Many of these people were first-time buyers without any experience in the bond market. In our view, the only debt a person should have is their bond, and they should split their savings between paying down their bond more quickly and building a stock market portfolio. Rates, of course, are expected to begin falling in September. Hopefully they will. Manufacturing production slumped 6.4% in March, mainly because of a drop in motor vehicle sales production, which was down 26%. Vehicle exports also fell 27% in March compared with the previous year. Then, of course, in April, motor vehicle sales rose to 38,000 vehicles sold. This broke the 8-month slump in sales and was up 2% year on year. The ABSA Purchasing Managers Index jumped to 54 in April from March's 49.2, and this shows how factory output improved rapidly without load shedding. Retail sales were up 2.3% in March, which is better than February's decline of 0.7%, and the whole of the first quarter sales were basically flat. They were actually slightly down by 0.1%. General dealers, which of course include supermarkets, saw sales up 6.4%. Sales are still less, however, than they used to be in 2019 before COVID-19. Obviously, high interest rates are partly to blame for this. But the government's Vulindlela program, which means open the road, Vulindlela, began in 2020, and it has been clearing administrative bottlenecks which have been impeding business from operating. It has impacted in telecommunications, transport, water, tourism, and energy. But the biggest impact has undoubtedly been on energy production, and that is raising production for businesses across the board. Transnet is also expected to improve as soon as the private sector starts to take over there. The backlog of water licenses has been cleared. That's another major factor. Tourism has improved also because of the visa system, which has been rationalized and made simpler and easier. But there are still problem areas. The Department of Minerals and Energy has a backlog of 5,300 applications for mining rights. A further 2,500 applications were submitted last year, and none of them have yet been processed. Red tape is blocking South Africa's best growth potential, which of course is in mining. Okay, let's look at the rand. It's obviously important here. The rand, let me just put the chart on the screen, a bit more data. The rand reached a cycle high or strong point over here where I'm pointing at 18.07 to the US dollar on the 21st of May. We said and have always said that strength was due to a switch in international investment sentiment towards risk on. Of course, at that point in the cycle, Wall Street had been breaking new record highs. Most equity markets around the world were following Wall Street up. Emerging markets, and especially South Africa, were benefiting from this risk-on sentiment. Overseas investors were looking for high returns, which of course we can offer. Then, over here, in this part of the chart, sentiment shifted back towards risk off, and Wall Street began to wobble. Wall Street was at this point going through a correction, which we saw earlier. The S&P fell back to test its support at the support level of 5254, and bearish sentiment washed over the emerging markets, and the rand fell back rapidly towards 1881 to the US dollar. Of course, the financial press at this time has been attributing the fall in the rand to the elections here in this country. But really that is completely incorrect. The election had nothing to do with the fall in the rand. It was more about international investors taking their money out of South Africa and moving into secure assets like US Treasury bills. This does not, of course, mean that the election is not a factor in the strength of the rand, but the uncertainty in the outcome has already been heavily discounted. For more than a year, it's been obvious that the ANC would get less than 50%, and that therefore they would have to make some kind of an alliance. The only part of that that's still unknown is how they will resolve this question of the alliance. The issues and the choices have been complicated by the surprisingly strong performance of MK, which was not anticipated. The ANC's choice will obviously have a direct impact on the rand, making it stronger if they make an alliance with the DA, and weaker if they make an alliance with either the EFF or the MK. In the meantime, the rand will continue to reflect international investor sentiment. Okay, just want to have a look at a few commodities. The latest report by Johnson Matthey says that there will be a shortage of platinum group metals towards the end of this year. The shortfall begins this year because of strong demand and limited supply. Of course, Amplats, Sibanye and Implats have all been retrenching staff and closing shafts, which is reducing supply. Johnson Matthey predicts that there will be a 500,000 ounce shortfall for platinum, and at the same time a 360,000 ounce shortfall for palladium. Palladium is in demand because of the move to battery electric vehicles, or BEVs. Both metals could experience a price rebound towards the end of the year. The iron and coal situation: bottlenecks at Transnet are impacting the production of iron at Kumba. Stats SA says that there's been a 6.7% drop in the production of iron in the first quarter of 2024. Kumba has reduced its guidance for the next 3 years to 35 tonnes from 37. And before the problems with Transnet began, it was expecting 40 tonnes. So that's quite a significant drop. Sorry, that's 40 million tonnes, yeah. The report also says that coal production was down 9.1% and platinum group metals production was down 3.6%. Whatever administration comes out of this election, the first thing it will have to do is to sort out the problems at Transnet urgently. Okay, let's look at some companies and company news from around the world, and the JSE in particular. Of course, the markets of the world, led by Wall Street, are currently in a correction, but that is a correction in a long-term bull trend, which, as we pointed out at the beginning, began in March 2009. The JSE has always been more volatile than world markets, and you would expect it to fall further and faster in this correction. So let's just have a look at that. Right, so I'm going here to the overall index, the JSE overall index, and here you can see the correction playing out, and you can see it is just that. It has fallen further and faster than Wall Street, which we were looking at earlier. It reached a record high. If we put more data on the screen, you can see the record high here was 80,509, and that was reached on the 26th of January 2023. And since then, the market has been moving down, sideways and downwards, until it picked up the upward momentum from Wall Street. And then we've now had this correction. Okay, so now on the 20th here, which is this cycle high here, the 20th of May, it came close to a new record high, but then fell back as Wall Street corrected. If you compare the overall index with the S&P 500, you can see that our market always moves further and faster in both directions. This also means that when the correction is over, which it may well be or close to being, then our market will recover more quickly. In the medium term, we can expect Wall Street to move up to new record highs, and of course we can expect the JSE to follow it up. Sim Chabalala, who's the CEO of Standard Bank, says that after 8 of the last 10 elections since 1980, the stock market in South Africa has gone up strongly, and he says this one will do the same. So that's interesting. Okay, let's look at some individual shares now. I want to begin with ISA Holdings. ISA Holdings is a technology company, and it specializes in security systems, right? So it has software and systems which help a company to secure its servers and its database against attacks by hackers. And this, of course, is a growing field. Every large company in South Africa has to have this type of protection. ISA also gets 88% of its income in an annuity form. In other words, these companies are willing to sign a contract and debit order an amount of money to ISA every month in order for them to manage the security at that company's servers. In its results for the year to the 29th of February, revenue was up 33% and headline earnings per share were up 35%. It's trading on a PE of 9.68, which seems very reasonable to us. And the dividend yield is a whopping 8.26%, which is really great. Anything above 5%, by the way, is of interest. Its customers prefer long-term continuous contracts for security systems. So it remains an excellent value company even at these levels. We put it on the winning shares list back here on the 8th of February or the 9th of February at 140 cents, and it's now moved up to 183, so it's doing well. Okay, the next share I want to talk about is Baldwin. We have talked about this share before. Baldwin is a large property developer in South Africa, and this is the chart. I'm going to put the 5-year chart on here so that you can see what's been happening in this company. And Baldwin specializes in building residential units in secure complexes, and it's a large property developer. This business is characterized by long lead times and massive projects, which means that its income and profits are inevitably lumpy and volatile. Of course, institutional investors do not like that. They prefer to have steadily growing earnings and income year by year. And they, of course, are the ones who have bid the share down. The share has been falling since 2021, as you can see from the chart, mainly because of its volatile income and earnings. Now the company is shifting towards renting out some of its units, and this will have the effect of stabilizing its income over time. Its annuity income is growing, and eventually institutions will have to take notice. Right now, however, the share is trading for just 190 cents. At this price, it is at 22% of its net asset value. In other words, its net asset value is nearly 5 times the share price. So that to us means that it's an absolute bargain. Remember that its net asset value is not intangible assets or intellectual property or something like that. Its net asset value is based mainly on property assets, which are not likely to lose their value, so it's very reliable. In its results for the year to the 29th of February, it showed 6.3 billion in developments under construction. That was what they valued their developments under construction at. This is obviously an asset on the balance sheet. Against that, it has development loans and facilities of just 1.1 billion, and its finance costs for the year were 50.6 million. And that is less than a quarter of its comprehensive income. We see this share as a bargain at current prices, one that should be accumulated by investors. You're literally getting value, a huge amount of value for what you're paying for the share. You may have to wait a while, but we believe that sooner or later the value in Baldwin will have to be reflected in the share price. Okay, now let's turn our attention to Lewis. Lewis is a very interesting company. It's one which we have liked for a long time. It is a well-known South African retailer of furniture and appliances, right? It has 869 stores, of which about 138 are outside South Africa, so most of its business is done inside the country. It's on a very attractive price-earnings ratio of just 5.29 and a dividend yield of 8.2%, which is very attractive. Even in a difficult economy, this company has grown sales by 4.7% and headline earnings per share by 7.1% in its most recent results. The company has very low gearing. Its debt is just 11.7% of the value of its assets. So that's very, very good. It also has cash to buy up other retailers that are in difficulties. During the year, it added 29 new stores, and it also bought back 170 million rands worth of its own shares at an average price of 47 rand and 6 cents. And as you can see from the chart here, the share closed last night at 48 rand 90, so it's making a profit on those share buybacks. It is a quintessentially South African company. It will benefit directly when interest rates begin falling later on this year. We added it to the winning shares list a little while ago. Just put a bit more data on the screen here. We added it to the winning shares list on the 1st of December. So that's somewhere over here. Let me just pick that up for you. There. On this day here, we added it to the winning shares list, and it was then 41 rand 50. It's now trading for 48 rand 90. So it's gone up very nicely since then. We still see it as a bit of a bargain even at these prices. Final share I want to look at is AME, African Media Entertainment. This is a fledgling company which owns radio stations and websites. Most notably, of course, it owns MoneyWeb. And once again, what I'm drawing your attention to here is the fact that we have had a substantial OBV buy signal. You can see that here. This is the on-balance volume chart in the middle here. This is the volume at the bottom, and there's the share price. And as you can see, it gave that OBV buy signal just over here on the 29th of May. Because of that buy signal, we added it to the winning shares list, and it has gone up sharply since then, because as you can see, the price is now over here at 47.47. We added it to the list here at 41.19. So this is a classic OBV situation, and it's an opportunity for you to make a short-term gain. You can see down here the surge in the volume traded over here, combined with slightly higher share prices. That shows you that somebody knows something, and they are accumulating the share. People in the know are buying up all the loosely held shares that they can lay their hands on in the market. Okay, folks, well, that's about all I've got time for today. I hope that you found something in that report which is of interest to you. And we'll speak again on the first Wednesday in July. Thank you for listening to me.